Have you ever taken a trade just before earnings season or before the budget and saw that your stop losses got sliced left, right and center? That's exactly how it looks like when you trade event. Budget, RBI policy, company earning. The days when the market doesn't walk but run. But these are also the days when the market creates villains as well as heroes. Some of the traders double their money, whereas some of them lose their entire capital. So, should you be trading on that day or not? Let's decode. Hi, I am Pranav VK, an NISM certified trader and trainer, and your guide at Stockshala by Kotak Securities. Event trading is when the market moves sharply because of companies announcing their earnings, RBI policy, or even the central union budget. It is during these times that you should be cautious and know when to trade and when not to trade. Some of the important events that actually create havocs in the market are Fed policy regarding inflation data, company earnings, the central union budget, as well as RBI policy. These events cause huge volatility in the market, which means it also translates to huge opportunities if you are prepared or huge losses if you are not. Let's understand why trading events are risky. Number one, there's going to be huge slippage. Second, the spread widens. Third, price whipsaws up and down. And finally, technical levels break instantly. It's like playing cricket during a thunderstorm. You might be a good player, but the pitch is still unpredictable. Now let's look at a real-life example of how much volatility is created in a market during a specific event. Here, I have taken the example of Nifty 50 index, and you can see that on 4th June 2024, there was a huge volatile day. Let's measure how much it was. On a single day, the market moved up and down by almost 8.5%, which is very unusual because on a normal day, Nifty generally moves anywhere between 0.2% to 1%. So now let's learn how pros handle event days. Number one, they make sure that they are looking at the calendar beforehand and they are well aware of what events are about to happen. Number two, when the time is near for any of the events, they reduce their position sizing. Number three, when they're setting their stop losses, they widen the gaps and also make sure they're reducing the position sizing. Number four, they focus on post-event markets, which means they wait for the dust to settle and then look for the right kind of entries. And finally, most of the professionals avoid trading during events and make sure that they're entering the markets only when the dust has settled. Now let's take a hypothetical example of Infosys earnings. Before the results are announced, the stock is quiet and the volumes are low. But on the day of the results, when the results are announced, there is huge volume as well as a gap up opening. What exactly are you going to do? The best thing to do is that wait for 15 to 30 minutes after the gap up and see if the price is sustaining above the gap or not. If the gap sustains above the price along with huge volumes, then ride the trend and enjoy the profits. But on the other hand, if the gap is slowly filling up, then you might wonder that if it's a trap. While a professional is going to handle gaps like this, what do you think an amateur is going to do? An amateur is going to enter the trade even before the results day and wait for God to show some luck. While the first way of doing it is professional trading, the second one is nothing but gambling. Here are three scenarios when you have to stay away during event days. If you are new to the markets, second, if you cannot handle high volatility, and third, if you do not have a clear plan. If these are some of the conditions that you categorize yourself in, then stay away from the markets during events. Skipping a dangerous trade is also a winning strategy. The markets are going to open up again tomorrow, and that is when you can trade calmly. So let's do a quick recap of what we have learned so far. Event trading is nothing but trading when there is an event like RBI policy, company earnings, or even the central budget. Trading during events are risky because of the huge volatility they bring into the markets, along with slippage as well as spreads. Pros: prepare for events and focus on reaction rather than prediction. The best thing to do is reduce your position sizing, wait for the confirmation, and then re-enter the markets post the event. If you like this video, go ahead and subscribe to Kotak Stockshala. I am Pranav VK and you're watching Stockshala by Kotak Securities, and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.